Good morning, everybody. Welcome to Don Zavis Sales Consulting. If it's Friday at 11:30 and Mountain Time in the Old Pueblo, guess where? You're going to find us right here. I'm John Waechter and flying solo today. And so one of the things that we're going to do today is we're going to invite a guest to come in, and she's right here, Cyndi Wilson. I've always had a traditional mortgage, and I've also gone in on occasion and drawn out some equity in a refinance process, and to home improvements or whatever. So what is the difference between pulling money out of a traditional mortgage or refinancing in a traditional way versus you used HECM and HELOC? So what are the
differences?
Yeah.
Okay, so your HELOC, home equity line of credit, that you're going to get from your banks and your credit unions, and it's going to be a line of credit that you can draw on. Now, it has an interest rate that is also variable, but you're also going to have to make a mortgage payment every month. Now, I understand that the line of credits on the traditional side will max out at 24%. So you might have 2%, but it could maximize out to 24%. So who wants to do that? Plus, you can only draw on it for 10 years. After 10 years, it's going to recast into a 20-year note. So you're going to make payments you no longer can draw unless you renew it and refinance it. So with the HECM, which is home equity conversion mortgage, reverse mortgage, with the FHA and the conventional, you'll have a line of credit. You'll be able to draw on it for the FHA. HECM, you can draw on it for life. It's going to have a 5% or a 10% cap on your interest rate on your margin. So I usually put everybody in the 5%. Why put them in the 10%? I would do what I would do for me or want done for me. So let's say right now, probably an average margin plus the index today is about 4.3. So it's even lower than the traditional mortgages and HELOCs right now. And then I put you in a cap. So you're not going to your interest rate will never grow above, let's just call it 9% to be easy. Right? Where on the traditional HELOC, you could go up to 24%.
Gotcha.
Right? Now, you can draw on it for life. It doesn't recast, and you're not required to make a payment. Here's another big myth. People think you can't make a payment with a reverse mortgage. Well, you can. So if you want to get a line of credit to remodel or do whatever, travel, but you don't want to see your line of credit increase because you're not making the payments, your four walls of the house is making those payments, you can make payments just like a traditional mortgage. The difference is you've got that cap. It's not a requirement. So if you have a life event that comes up and you can't make that payment, you're okay. So
can you inside your own financial strategy mentally convert your payments into an interest-only loan, so you only pay interest and so your equity in your home stays constant?
So every month you're going to get a mortgage statement just like the traditional mortgage statements. So, and on that mortgage statement, it's going to show how much interest was charged that month. With the FHA, since it's insured, it's also going to show the mortgage insurance. If you have the jumbo conventional, obviously it's not insured, so you don't have that monthly mortgage insurance. So so you can see if you want to keep your principal balance where it's at, each month you're going to see how much interest accrued, make that payment, and then you're still at your principal balance that you started with. Just keep in mind, let's say you didn't make a payment for 6 months and now you want to start making payments. Your payments are going to go to that interest and the mortgage insurance and then to your principal. So you can catch it up and still keep your principal balance where you would like it to be